The next outage will. The rider staircase, how bills rise between cases. Between full-rate cases, the bill learns new tricks. They arrive as narrow filings with comforting names: distribution system improvement charge, storm cost recovery rider, vegetation management adjustment. Each promises to recover prudently incurred costs for a specific purpose. Each is temporary. None feels temporary once it lands. Here's the rhythm. A utility files to launch or expand a rider with a defined scope. Regulators approve a cents per kilowatt hour adder or a monthly customer charge, often with an annual reconciliation. Work proceeds. The rider collects. When the period ends, remaining balances true up. Meanwhile, a new rider arrives for a different bucket. You're not facing one surcharge. You're climbing a staircase of them. The genius is timing. In a traditional case, everything gets litigated together: revenues, expenses, investment, performance. Riders break the bundle. Storm costs can start flowing months after the event. Vegetation cycles can be front-loaded into the season. Infrastructure replacements can kick in at the beginning of a multi-year plan. Cash moves quickly, scrutiny fragments, and the total finds you before a headline ever does. Cash flow alignment is the phrase you'll see. It sounds reasonable. Don't make the company wait years to recover dollars it already spent to keep the system safe. But alignment cuts one way. When storms are light, few riders refund proactively. When vendor prices come in under estimate, the rider doesn't always ratchet down mid-cycle. The reconciliations happen later, quietly, while new riders arrive noisily. Now look at compounding. Imagine 3 riders at once: infrastructure, storm, vegetation. Each adds $1 or $2 a month, or a half cent per kilowatt hour. Stack them, and a modest home sees 10, then 18, then 30 extra dollars before any base rate change. Layer in a grid modernization rider approved last year, and a transmission adder set by regional tariffs, and the staircase steepens. You aren't paying one bill. You're paying 5 bills folded into one envelope. Fixed charges make the staircase feel steeper for low users. Riders tied to a flat monthly amount hit an apartment dweller harder than a large house because a bigger share of the total becomes unavoidable. Riders tied to kilowatt hours still stack on top of base energy rates, but decoupling true-ups can offset conservation gains. The signal gets muddy. Turn off lights, and a rider eats the savings. Small businesses feel it in margins. A bakery that proofed dough at night to dodge peak rates still pays the storm rider on every kilowatt hour and a flat infrastructure fee per meter. The owner raises the price of a loaf by a quarter and cuts a Wednesday shift. Upstairs, the landlord passes through the same riders to tenants on Plus Utilities leases. No one links the quarter at the register to a line a continent away, but the push is the same. Riders also reshape politics inside a class. Large users lobby to structure riders volumetrically. Low-usage advocates push for per-kilowatt-hour design to preserve a conservation signal. Utilities prefer fixed charges to stabilize revenue. Commissions split differences, then add balancing riders to smooth impacts. The staircase looks fair on paper and unfair on Tuesdays when the bill lands. Prudence reviews exist, but they arrive late. A storm docket 2 years after landfall confirms some costs were high, disallows a tranche of contractor overtime, and orders a credit. The credit appears as a small negative line on 3 bills while a new wildfire mitigation rider begins. You technically got your money back. The net still marches up. Then there's harmonization. In multi-division systems, riders can align territories. Town A's rates move toward Town B's averages as a regional vegetation rider spreads costs. Customers who had historically lower delivery rates lose the advantage without a single pole replaced on their street. The file calls it consistency. Your kitchen calls it a surprise. The escape hatch is supposed to be sunset clauses. A rider ends when the bucket empties, but buckets refill. Infrastructure plans become rolling programs. Pilot hardening becomes evergreen resilience. Storm seasons don't stop. Even when a rider zeroes, a successor appears with a new docket number and familiar language. You can track it if you're stubborn. Pull 12 months of bills. Highlight every line that isn't base distribution and energy. Note the codes R, RM, DSIC, SMP. Add them month over month. That rising sum is the staircase you're climbing between cases. Then scan the commission's calendar. You'll find the hearings that created those lines happened on Wednesday mornings with 6 people in the room. Riders aren't villainy by themselves. They fund real repairs fast. The harm is in accumulation without outcomes. If your outage minutes don't drop, if trees still scythe through the same feeder, if arrears rise and shutoffs resume, the staircase financed motion, not progress. That's the place to push. Require sunsets that actually sunset, tie continuation to verified results, and force bill impact tables that show the stack for a studio, a family of 4, and a corner store. Because once you see the steps, you can stop climbing blind. The green pretext, clean energy as CAPEX engine. Clean power is real. We need it. But inside the utility profit machine, clean also doubled as the perfect accelerator pedal. Transmission, storage, inverter upgrades. Every category fit neatly into the rate base. The climate story made it urgent. The accounting made it lucrative. Start with transmission. New wind belts and solar basins sit far from cities. To move that power, utilities propose billion-dollar high-voltage lines, step-up stations, and rights-of-way that take years to secure. On paper, it's nation-building. In the ledger, it's decades of return on assets. The longer the line, the larger the rate base. Cost allocation fights rage at the edges, but once the order hits, customers fund it through tariffs that rarely shrink. Then come renewable interconnections. Utilities publish glossy roadmaps, thousands of megawatts queued, transformer banks expanded, feeder upgrades scheduled. Necessary pieces. Also prime capitalizable chunks. A substation enlargement that could be solved by targeted non-wires alternatives becomes a rebuild. Hosting capacity maps arrive late, interconnection deadlines slip. Meanwhile, the CAPEX plan slides forward intact, sized to a growth rate investors already expect. Storage is the new darling. Batteries smooth peaks, firm solar, and help avoid gas peakers. They can also be sized beyond need. A 1-hour unit becomes a 4-hour block for resiliency. Converter rooms grow. Fire suppression adds premium features. Each safety step is defensible, the total swells. Stack enough megawatt hours, and you've created a depreciation schedule that pays for years. Whether operations dispatch them well becomes a later question, one the bill can't answer. Retirements create the second harvest. Coal units exit. Securitization bonds appear to pay stranded costs. Ratepayers repay those bonds over decades. At the same time, replacement resources, renewables, storage, transmission, flow into the rate base with fresh returns. It's a finance two-step. Monetize yesterday's plant while earning on tomorrow's portfolio. The energy transition is the reason. The earnings profile is the result. Overbuild risk creeps in through capacity planning. Regional markets set reserve margins. Utilities model peaks. Peaker plants and storage get justified for extreme hours that might arrive a handful of days a year. Instead of demand response at scale, cheaper, quicker, OPX, steel answers show up because steel earns. A 300 megawatt peaker that runs a dozen hours annually looks absurd to a layperson and completely normal to a spreadsheet linking investment to return. Rooftop solar stands at the awkward intersection. It reduces delivered kilowatt hours and can defer some wires upgrades if integrated well. But it also threatens volumetric recovery and slows rate-base growth. So fixed charges rise. Net metering gets rescoped. Minimum bills expand. The rhetoric is fairness, cost shift. And there's truth there. The quiet piece is incentive alignment. Distributed assets owned by customers don't feed utility returns the way utility-owned assets do. Green, if owned, is a profit center. Green, if customer-sited, is a problem to be managed. Watch how riders carry this. Renewable integration, transmission cost recovery, clean energy adjustment, all appear between cases, aligning cash flows before prudence reviews land. Federal policy sweetens the runway with tax credits. Utilities propose regulatory assets to capture development costs. When grants exist, you'd expect ratepayers to benefit first. Too often, filings treat grants as accelerants to CAPEX, not substitutes. The plan gets bigger, the bill follows. Investors know this script. Presentations stack phrases: energy transition, electrification, AI load growth, beside charts showing rate-based CAGR. The climate narrative unlocks capital from funds that would have balked at old-school wires. It also dulls local scrutiny. Oppose a line, and you're anti-progress. Ask for non-wires alternatives, and you're told the clock won't wait. Meanwhile, value-for-money tests stay buried in annexes. There's a better way to aim the same dollars. Run competitive solicitations for non-wires alternatives wherever they can defer substation expansions. Tie ROE adders to verified outcomes. Outage reductions, peak shaved, emissions avoided per rate-based dollar. Require open hosting capacity maps that update quarterly. Enforce interconnection timelines with automatic credits. Push grants first, with explicit bill credits showing taxpayers funded the asset so ratepayers don't pay twice. Demand transparent capacity studies that publish assumed load shapes, including demand response and managed EV charging, before approving storage blocks sized like peakers in disguise. And if rooftop solar and community solar threaten revenue stability, redesign the business model. Let utilities earn a regulated service fee for integrating third-party resources that demonstrably defer capital. Pay for orchestration, not just ownership. Align return with the least cost path to reliability, not the most capital-intensive version of the same promise. Because the transition isn't the pretext. The pretext is using the transition to maximize rate base without measuring results customers feel. If your bill carries a clean energy rider, you should see cleaner power and a sturdier street. If instead you get another insert about resilience while your outage map blinks red, you funded a story. The next docket is where that changes. When you ask for outcomes first and CAPEX second, and make the allowed return follow. Disaster finance, storms, wildfire, and guaranteed recovery. Disaster used to mean emergency budgets, bond debates, and hard choices. Then utilities learned how to turn catastrophe into a product. Today, storms, wildfires, and freezes sit inside financial structures that move money faster than crews move bucket trucks. Structures designed to smooth risk for companies and push it onto bills labeled recovery. Start with catastrophe bonds. A utility, or a state risk pool, sets up a special vehicle. Investors put cash in. If no disaster meets the trigger, say, wind speeds below X or a drought index above Y, they collect a juicy coupon and get their principal back. If the threshold is breached, principal flows to the sponsor to pay emergency costs. Parametric triggers mean no adjusters, no litigation, just a data point, certified, and money releases. It's speed for the operator and a non-correlated return for the buyer. Your role: paying the coupon through a rider tucked under resilience. Storm securitization is the next ladder. After a major event, the utility tallies extraordinary costs, overtime, contractors, materials, destroyed assets, and asks to turn that pile into long-dated bonds backed by a dedicated charge on your bill. Regulators approve if the math beats traditional financing. Investors buy because the cash flow is effectively guaranteed by statute. You repay with interest for 15, 20, sometimes 25 years. The storm is gone. The charge endures. And because securitization sits off the company's balance sheet, it preserves room for more capital spending, on which they'll still earn returns. Wildfire liability rewrote playbooks. In high-risk regions, utilities faced ruin after ignitions linked to their lines. Legislatures stepped in with funds, prudent standards, and cost recovery lanes. Vegetation riders grew. Public safety power shutoffs became a tool. Kill circuits preemptively to avoid blame. The incentive is clear. If risk raises, the allowed return and recovery is likely. The finance equation rewards mitigation portfolios sized to earnings targets. A hillside stays flammable, the filing thickens, the bill adds a line. Listen to the language: risk transfer, credit positive, cash flow alignment. It's not wrong. Cap bonds pay quickly. Securitization lowers near-term pressure. Liability reform can keep a grid investor grade when fires are seasonal. But the human side feels different. A family buys a generator because shutoffs keep coming. A diner on a rural highway throws away food after a planned outage runs long. Months later, both see a wildfire mitigation charge, a storm recovery rider, and a resilience fee. They underwrote faster finance and slower service. These tools also create strange incentives. Parametric triggers pay on the event, not the outcome. A bond releases when wind hits the threshold whether the utility's prep actually reduced damage. Securitization moves yesterday's costs into tomorrow's bills, freeing today's budget, and diluting urgency to reform maintenance practices that would shrink the next tab. Shutoffs protect the balance sheet, but also shift harm to communities least able to absorb it. If the spreadsheet rewards capital plans and transfer mechanisms more than trimmed rights-of-way and extra patrols, companies will optimize to the sheet. You can see the loop. A winter storm crushes a region. In the aftermath, emergency riders begin. The next filing adds a hardening portfolio: poles, reclusers, underground bundles, some smart, some showy. A year later, securitization bonds arrive to sweep remaining costs off the books. That fall, a wildfire season triggers public safety shutoffs. The following spring, vegetation riders increase, and a parametric program refreshes. Nothing here is illegal. Everything here is rational. If your goal is to stabilize earnings first and service second, there's a better way to use the same finance. Tie cat bond coupons to performance. Lower premiums when verified risk reductions land. Line miles hardened where fires start, circuits reprofiled from worst performing to average. Make securitization contingent on reforms. Independent audits of vegetation cycles, hotspot patrol frequencies, and contractor training. Write wildfire riders with neighborhood equity metrics. The worst circuits get funded first. Automatic bill credits apply when shutoff hours exceed plans, and shutoffs require a published alternative: backup power at clinics, cold storage at community hubs. Then lock accountability to the money. Every resilience rider sunsets unless targets clear. SAIDI down where it's been worst, ignition risk score reduced on named feeders, restoration times trimmed for medically vulnerable customers. Publish a disaster ledger households can read. Bonds outstanding, years remaining, bill impact by apartment, ranch house, and corner store. If the tool shifts risk to ratepayers, it should shift power to them too, in the data and in the docket. Disaster finance isn't going away. Storms are stronger. Fire seasons are longer. The question isn't whether we pay, it's what we buy. A structure that guarantees recovery without guaranteeing improvement is a promise to the wrong party. Tie the dollars to outcomes you can feel when the wind rises, and the next envelope might still carry a storm charge, but it will also carry a shorter outage. Service erosion: fewer crews, slower fixes, higher risks. You can chart service erosion by listening to hold music. A storm takes a feeder down. A mother calls to report a line arcing across her back fence, and the automated voice says, "High call volumes." 20 minutes later, she's still on hold. Somewhere, a dashboard shows it instantly. But the truck that fixes it isn't on the screen. It's stuck on a longer roster. This is where CapEx bias turns into hours without power. OpEx, people, training, patrols, trimming, spare parts staged close to failure points, doesn't earn a return. So when guidance demands expense discipline, the belt tightens around crews first. Retirements slip by without replacements. Apprenticeships get deferred a year. Third-party contractors rotate in for storm season and disappear before they learn a circuit's quirks. The institutional memory that once lived in a lineworker's hands drains out of the room. Vegetation management is the tell. The cheapest pass trims everything the same: fast, shallow, repeat next year. Risk-based hardening takes maps, local knowledge, and time. Species, growth rates, prevailing winds, past fault histories. It means going deep where you must and skipping where you can. But the bid that wins a spreadsheet is miles per dollar. Crews do exactly that. You see it after a wind event. The circuit with 2 chronic hazard trees trips again, while a few blocks over. Branches a foot from the line survived untouched because the contract required miles, not risk. Advanced meters don't clear debris off a crossarm. A self-healing circuit can't close if the recluser never gets maintenance. Dashboards multiply, wrench time shrinks. In the control room, operators stare at more alerts than staff can triage. Meanwhile, a rural substation waits for a breaker that's been on backorder. The emergency spare cannibalized for last month's outage and never restocked because inventory targets were tightened to save a few basis points. Safety bends when staffing does. Pairing rules get stretched on a quick job. Fatigue sets in during a 7th consecutive 12-hour shift. A contractor unfamiliar with the company's switching procedures misses a step, and a near miss stays near by luck. The incident rate ticks up a hair, brushed off as volatility. What it really means is the margin for error is gone. When you run hot, you run brittle. Listen to field radios after a big event. Crews ask dispatch for switching orders. Dispatch is overwhelmed. A mutual aid team from 3 states away can't find a lockbox because the stadium naming rights vendor now also standardizes substation hardware labeling, and the standard hasn't reached this yard. Coordination time choose daylight. Restoration slips a day. The next morning's bill insert thanks you for patience and reminds you of the company's ongoing investments in resilience. The human cost isn't only lights out. It's boil notices that cascade because a lift station lost power longer than planned. It's a grocery tossing a walk-in full of dairy at 2 a.m. It's a dialysis patient on a portable battery praying the estimated time of restoration is real this time. It's a volunteer fire crew navigating dark intersections because the signal retimers haven't been serviced in 6 months. Every one of those is an operating decision that got outvoted by an asset plan. Outsourcing can work, but not at a sprint. When contractors churn quarterly, training never sticks. The utility saves on benefits and loses on consistency. Line by line, the knowledge of which gates are locked, which easements flood, and which poles sink after a thaw disappears. A map doesn't capture that. A veteran who remembers a 2009 ice storm does. He retired last spring. Paper performance hides the drift. Sadie and sci-fi averages improve a whisper because minor blinks count, and automation cleans those quickly. The long, life-interrupting outages, the 8-hour restore after a limb tears down a span, don't budge. Customers feel those, not the micro-faults. But the metric was good enough for a press release and a rate rider renewal. Ask crews what would shorten the next storm. You hear the same list. More saws on the right circuits, deeper trims where the wind comes from, extra spares staged ahead of season, apprentices paired with vets, and a supervisor who can say yes to overtime without calling 3 layers for permission. None of those earns profit. All of them by back hours of your life. This spiral isn't inevitable. Commissions can require staffing benchmarks tied to outage reductions, not headcount for its own sake. Vegetation plans can be risk-scored and audited in the field, with automatic bill credits when cycles slip. Performance-based regulation can put a slice of allowed return at risk if restoration targets aren't met where they've historically been worst. Procurement can break vendor lock-in, so maintenance software doesn't dictate how a crew rolls. When you see a resilience rider on your bill, ask for the roster behind it. How many qualified line workers per 1,000 miles of line? What's the median response time by zip code? How many miles trimmed by risk class, not just miles? Require those answers in plain tables, not annexes. Because service erosion doesn't start with a storm. It starts when the spreadsheet treats people as a cost center and steel as a profit center. If the envelope keeps getting heavier while the lights don't come back faster, it isn't because no one knows how to fix it.